Hello and welcome back to the lesson. The subject is Advanced Auditing and Assurance. Today we are going to study the subtopic Subsequent Events. Then we will consider the audit work that is done between the financial year end and date of signing the financial statements. But first of all, we're going to define subsequent events. Then we'll give a few examples of subsequent events so that you can be able to understand the meaning of subsequent events. Now, candidates, what are subsequent events? Subsequent events are events or transactions that occur after the financial year end, but before the date when the financial statements are authorized or issued. So assuming the financial year ends on 31st of December and the financial statements are authorized and issued, say, in 20th of January. So the time that lapses or the events that takes place between the date of signing financial statements and the financial year end, the events that occur, the transactions that take place between that time are what we are referring to as subsequent events. And such events can have a significant impact on the entity's financial position. It can have significant impact on results of operations as well as disclosures. And there are two main types of subsequent events. There are types of subsequent events that can be classified, let me say, into two categories. We have what we call recognized subsequent events, recognized subsequent events. That's the first category. Then there is the unrecognized subsequent events. But let's first of all define recognized subsequent events. Now, what are recognized subsequent events? These are events that provide additional evidence about conditions that existed at the financial year end. Remember, we've said that subsequent events are transactions or events that take place between the financial year end and the date of signing the financial statements. I repeat, subsequent events refer to events or transactions that occur after the financial year end, but before the date of signing the financial statements. And there are two main categories of subsequent events. The first one is recognized subsequent events. Recognized subsequent events are those that provide additional evidence. They provide additional evidence. These are events that provide additional evidence about conditions that existed at the financial year end, all right? And require adjustments to the financial statements. And they require adjustments to the financial statements. So, number one, recognize subsequent events. These are events that happen between the year end, and the date of signing the financial statements. Another feature about these event is that they provide additional evidence about the position, about the conditions that existed at the financial year end. And then they require adjustments to the financial statements. In other words, these events affect the financial statements recognition, measurement, and disclosure. They affect the financial statements. These events affect the financial statements. Now, to make you understand clearly, I'll give a few examples of recognized subsequent events. One obvious example is a settlement of litigation. Settlement of litigation. If a lawsuit or legal dispute is settled after the financial year end, then the settlement amount may need to be recognized and reflected in the financial statements. So number one, this settlement of litigation happened after the financial year end. Do you understand? It happened after the financial year end. So we are saying such an example is an example of a recognized subsequent event, which you have said it affects the financial statements, it needs to be adjusted, and it provides additional evidence. And therefore it has to be reflected in the financials. An adjustment has to be made. If a legal dispute is settled after the financial statement, but before the date of signing financial statement, then that has to be reflected in the financial statements. Number two is purchase or sale of assets. Purchase or sale of assets. Now, if a significant acquisition or disposal of assets occurs after the financial year end, then adjustments may be necessary. Why? To properly reflect the impact on the financial statements. If assets are sold or purchased after the financial year end, but before the date of signing financial statements, that is a recognized subsequent event that require adjustments to the financial statements. 3, bankruptcy. Bankruptcy. If an entity files for bankruptcy after the financial year end, but before the date of signing financial statements, it may impact the valuation of assets. It may impact the recognition of liabilities. It may also impact the presentation and disclosure in the financial statements. So such an event has to be adjusted. It will impact the valuation of assets. So if it impacts the valuation of assets, then that has to be reflected in the financial statements before the date of signing the financial statements. It's a subsequent event. Bankruptcy. I'll give more examples. Changes in accounting estimates. Changes in accounting estimates. Changes in accounting estimates. If there are changes in estimates, such as impairment or provisions, after the financial year, then adjustments should be made to reflect the changes. Do you understand? If there are changes in estimates, accounting estimates, then that's a recognized subsequent event, and therefore adjustments has to be made to the financial statements to reflect the changes. So these are recognized. Number one, recognized subsequent event. I'll discuss here number two, non-recognized subsequent events. Non-recognized subsequent events. This is the opposite of recognized subsequent events. Okay? Non-recognized subsequent events are those events that provide information about conditions that arose after the financial year end. They provide evidence about information that arose after the financial year end. And therefore, these non-recognized subsequent events do not need adjustments, do not require adjustments to the financial statements. Instead, they may require disclosure in the footnotes of the financial statements to inform users about significant events or transactions. These are subsequent events that do not require adjustments. These are transactions events that do not require adjustments. I've said these events or transactions provide information about conditions that arose after. They provide information about conditions that arose after the financial year end. The recognized subsequent events provide additional evidence of conditions that existed before the financial year end. These ones provide information about conditions that arose after the financial year end. Do you get the difference? This is after the financial year end. This one is before the financial year end. Do you get the difference? Why adjustments are required when recognized subsequent events occur? Do you understand why adjustments are not required when non-recognized subsequent events occur? So let's now give examples. I'll give examples just the way I did in the case of recognized subsequent events. Examples to help you understand clearly is issuance, number one, issuance of debt or equity. A, issuance of debt or equity. Issuance of debt or equity. If a company issues new debt or issues new equity securities after the financial year end, it may not disclose, it may disclose to inform users about the subsequent financing activities. So here, non-subsequent event, no adjustments are necessary, but the company can make it as part of the disclosures to the financial statements. Does not require to adjust. Adjusting the financial statement is not necessary, but the company can disclose it as a footnote in the financial statement. 2, natural disasters. Natural disasters. If a natural disaster occurs, after the financial year end, it may not require adjustments to the financial statements, because a disaster is something that is not expected. It's not something that is expected. So you cannot say it provides evidence, additional evidence to the existing conditions. No. It does not provide evidence to the conditions that existed before the financial year end. Does not do that. And therefore, no adjustments are required. Do you understand? It may not require adjustments to the financial statements, but should be disclosed to provide information on the significant impact of the disaster on the entity's operations or financial position. It is a non-recognized subsequent event, a non-adjusting event. 3, significant business acquisition. Significant business acquisitions. If a company acquires another business after the financial year end, then the details of acquisition, such as the purchase price and the impact on the financial statements, may be disclosed. It is a non-recognized subsequent event. No adjustments are required, but such an event has to be disclosed as a footnote to the financial statements to help users understand the effect of such a purchase on the financial statements. Significant business acquisition. Number 4 is changes in regulations. Changes in regulations. If there are changes in regulations or changes in laws that affect the entity's operations or financial position after the financial year end, such changes may be disclosed to inform users of the financial statements. Just require disclosure. Do you understand? It is a non-recognized subsequent event, a non-adjusting event. It does not need to, it does not require adjustments. It only provides information about conditions that arose after the financial year end. Change in regulations is evidence of information that existed after the financial year end. But things like settlement of litigation after the financial year end, we require adjustments. Why? It's because before the settlement of litigation, there was a dispute. So if settlement is made after the financial year end, but before the date of signing the financial statements, then this has to be adjusted. The financial statements must be adjusted. As the same as purchase or sale of assets. Adjustments are necessary. Bankruptcy, adjustments are necessary. Estimates, changes in accounting estimates, adjustments are necessary. So candidates, that's the meaning of subsequent events. I've defined subsequent events. I've identified the types of subsequent events. That is the recognized subsequent events, and the non-recognized subsequent events. Do you understand the difference? Do you get the difference? So candidates, before we look at the audit work done between the financial year end and the date of signing the financial statements, it's important to note that management and auditors, it is important for management and auditors to evaluate subsequent events to determine their impact on the financial statements. Because recognized subsequent events we've seen require appropriate adjustments, while non-recognized subsequent events may necessitate additional disclosure to provide users with relevant and timely information. And this ensures that the financial statements reflect the most current and accurate information available at the date of issuance. When adjustments are made, then it means that information is accurate, information is current for the users. Now let's now discuss the audit work that should be done between the financial year end and the date of signing the financial statements. Now, candidates, between the financial year end and the date of signing the financial statements, auditors perform specific audit procedures related to subsequent events. And these procedures aim to gather evidence about events or transactions that occurred after the financial year end but before the date of signing the financial statements. So we're going to look at the procedures that the auditor has to carry out during this period. Audit work. Audit work done between the financial year end and the date of signing the financial statement. The first one is inquiry. Inquiry, and also what we call analytical procedures. And analytical procedures. Inquiry and analytical procedures. That's the first audit work. Now, auditors make inquiries of management and key personnel regarding any significant events or transactions that have occurred after the financial year end. Inquiries, asking questions of management, asking the key personnel questions. That's the meaning of inquiry. You ask the top management of any major events that may have occurred after the financial year end. Auditors may also perform analytical procedures. These are procedures to assess whether there are any unusual or unexpected fluctuations or relationships in the financial data that may indicate the occurrence of subsequent events. So the auditor may make inquiries from the management or can carry out analytical procedures using financial data. Okay? So that after carrying out analytical procedures, you can identify any unexpected fluctuations or any unexpected or unusual relationships in the financial data. That is the first audit work. Number two, review of subsequent events documentation. Review of subsequent events documentation. Reviewing subsequent events documentation. What are these documentations? This could be the minutes of board meetings. This could be the documentation in relation to management discussions or any other relevant records. So the auditors review the organization's subsequent event documentations, which include the minute of board meetings, the management discussions, and so on. And by reviewing these subsequent events documentation, this can help identify any material subsequent events that may have an impact on the financial statements. So candidates, after the financial year end, the auditor should carry out this procedure. The auditor should seek to review subsequent event documentation. And by subsequent events, we are talking about the events or transactions that takes place after the financial year end, but before the date of signing the financial statements. So between that period, if it's 1 month, then the auditor should check if there are any management discussions, if there are any board meetings. If there are any board meetings, then the auditor should review the board meetings, the minutes of the board meetings, so that he can find out if there are any subsequent events which may impact significantly the financial statements of the organization. If there are any material subsequent events, then that can come to the knowledge of the auditor by reviewing subsequent events documentations. Do you understand, candidates? Subsequent events documentation, there is no specific document known as subsequent event. No, these are the documentation that this is documentation in relation to events that takes place between the financial year end and the date of signing the financial statements, and that could be the minutes of board meetings and even minutes of management discussions and so on. That is a procedure, an audit procedure or audit work done between the financial year end and the date of signing the financial statements. 3, cut-off procedures. Cut-off procedures. Auditors perform what we call cut-off procedures to ensure that transactions and events are appropriately recorded in the correct accounting period. And auditors review documentation such as invoices, contracts, bank statements, and any other supporting documents in order to do what? To verify that the transactions are recorded in the correct financial year. So during this period, the auditor should carry out cut-off procedures so that the events that occur between the financial year end and the date of signing financial statements are events or transactions that relate to the financial year under consideration, so that the information is that relates to the financial year is recorded in the current financial year and not the subsequent financial year. Cut-off procedures. Number 4, evaluation of recognized subsequent events. Evaluation of recognized subsequent events is another audit work that can be carried out during this period. Evaluation of recognized subsequent events. Now, auditors here assess whether any recognized subsequent events require adjustments to the financial statements. And that involves evaluating the impact of the events on the financial statements and ensuring that the adjustments are appropriately reflected in the financial statements. Evaluation of recognized subsequent events. That's another audit procedure. 5, disclosure of non-recognized subsequent events. Disclosure of non-recognized subsequent events. Remember, we said that non-recognized subsequent events do not require adjustment, but these are events that must be disclosed in the financial statements under the footnotes. Auditors here determine whether any non-recognized subsequent events require disclosure in the financial statements, and that includes evaluating the materiality and the relevance of events and ensuring that appropriate disclosure are made in the financial statement footnotes. Six, updating risk assessment. This is yet another audit procedure, updating risk assessment. Auditors update their risk assessment and evaluate the impact of subsequent events on the assessed risks. And the auditors consider whether any new risks have emerged or whether the existing risks have changed as a result of the subsequent events. As a result of the subsequent events. Updating risk assessment. 7, management representations. Management representations. Here, auditors obtain written representations from management regarding subsequent events. And these representations confirm that management has disclosed all non-subsequent events that are relevant to the financial statements and that appropriate adjustments and disclosures have been made. So the auditors must seek management representation letters from the management in relation to subsequent events. And in looking for or requiring or asking for these management letters, representation letters, the auditor must confirm that the management, number one, has disclosed all non-subsequent events, and these are events that are relevant to the financial statements. And number two, appropriate adjustments have been made. And lastly, appropriate disclosures have been made. That is an audit procedure. That is the audit work done before the date of signing the financial statements. Then lastly is a review of events. Review of events. This is review of events occurring after the date of the auditor's report. Review of events occurring after the date of the auditor's report. That is the audit procedure that has to be done. Review of events occurring after the date of the auditor's report. Auditors review any events or transactions occurring after the date of their report, but before the financial statements are issued. They assess whether there is need to update the auditor's report or include subsequent event disclosures. Do you understand? So these are the audit procedures that must be carried out before the date of signing the financial statements. And that is between the financial year end and the date of signing the financial statements. So that will mark the end of our today's lesson, where we've defined subsequent events. By now, you should now be able to define subsequent events. We've also identified the types of subsequent events. We've said, first of all, that subsequent events are events or transactions that take place between the financial year end and the date of signing financial statements. We've categorized the subsequent events into two. That is the recognized subsequent events, which we defined to be events that provide additional evidence of the conditions that existed before the financial year end. We also say that these are events that require adjustments to the financial statements. We also mentioned that these are events that affect the financial statements, and that's why adjustments are necessary. We've gone ahead to give examples of recognized subsequent events. Number one is settlement of litigation. Number two, purchase or sale of assets. Number three, bankruptcy. Number four, changes in accounting estimates. 1, 2, 3, 4, given 4 examples. Then we defined non-recognized subsequent events. Non-recognized subsequent events. We say that these are events that provide information about conditions that arose after the financial year end, and such events do not require adjustments to the financial statements. And we've gone ahead to give examples. 1, issuance of debt or equity securities. Number 2, natural disasters. Number 3, significant business acquisitions. Number 4, changes in regulations and laws. That we did in our today's lesson. Then we finally discussed in this lesson audit work done between the financial year end and when the financial statements are issued or authorized. We've outlined 8 audit procedures. Number 1 is inquiry and analytical procedures. These are 2 in 1. Inquiries, making inquiry of management, making inquiry of the key personnel of any events that may have occurred during that period. The second procedure, audit procedure, is review of subsequent events, documentation. Review of subsequent events, documentation. If there are any events that occurred between the financial year end and the date of signing the financial statements, documents such as the minutes of board meetings or documents about management discussions, the auditor should review such documentation so that he can establish if there are any significant subsequent events that require disclosure or that may cause the financial statements to be adjusted. Cut-off procedures, number 3. Evaluation of recognized subsequent events, number 4. Number 5, disclosure of non-recognized subsequent events. That is another procedure that has to be carried out by the auditor. Number 6, updating risk assessment. Number 7, management representations. The auditor must get representations from management. Okay, obtain written representations from management regarding subsequent events, and these representations confirm that management has disclosed all known subsequent events that are relevant to the financial statements, and that appropriate adjustments and disclosures have been made in the financial statements. Then lastly, review of events occurring after the date of the auditor's report. The auditor also has an obligation to review the events occurring after the date of the auditor's report. And in closing, candidates, the work done between the financial year end and the date of signing the financial statement is crucial in ensuring that the financial statements are accurate, complete, and that they reflect the most up-to-date information available. This work also helps auditors identify subsequent events that may require adjustments or disclosures, at the same time maintaining the reliability and the relevance of financial reporting. And on that note, we bring the lesson to a close. Subsequent events and audit work done between the financial year end and the date of signing the financial statements. Thank you. God bless you.